so that you can really maximize on it. Now, what we've seen in last couple of days is that the hangover of Santa rally seems to be getting over. It's visible in the way how markets essentially are moving in a very tight range. The range could be well defined that in last 7-8 trading sessions, Nifty has just barely moved by about 1,000 points from the lower end of the range to the upper end of the range, or the upper end of the range to the lower end of the range. What will be the influencing factor? It's going to be earnings. Later this week, India's biggest IT company, TCS, will hit the Dalal Street and they will kickstart the earnings season. So what should we expect from the earnings season? How could it influence your portfolio? All that and much more on this edition of Tracking Trends with me, Nikunj, Dalmia. But before that, here's a look at headlines. Nifty is back above 21,700, which is from the lower end of the range. Looks like we are bouncing right up, and that's really been the market. One step forward, one step back. It's not two step forward or two step back. One step forward, one step back. Markets are jumping in the same place. Broader market also, not a bad day, both in terms of absolute gains and real gains. All sectors are trading in green excepting media, largely because of Z, and then IT stocks are gaining ahead of numbers. So the big question we are addressing on this edition of Tracking Trends is, are we in for a good earnings season? If you're in for a good earnings season, is there a case for markets to get re-rated despite a strong gangbuster move or a monster rally what we've seen between October and December? Let's take that point forward to let me establish the tone now. So what are the broader earning expectations? First, the big picture. For the quarter gone by, the universe which we track, revenue is expected to grow in the region of about 5%, EBITDA by 7%, PAT by 12%, and given where commodity prices had moved, everyone in a sense is hoping that there could be an aggregate margin expansion, not a contraction of about 0.5%. Three sectors where expectations, I guess, are running large. Consumer discretionary, base effect has kicked in. Auto sales have been strong. Interest rate seems to be peaking out. The general expectations are that for the quarter gone by, earnings will grow in the region. We'll talk about percentage numbers here first. Consumer discretionary will show an uptick of 21%, NBFCs 18%, industrial 16%. But for IT, nobody is expecting any growth. For utilities, flat growth, and for energy, minus 7%. Manish Sonthalia joins us. Let's take our conversation forward. Manish, the big question is, we've seen a monster rally in October, November, December. While earnings season is not going to change because of what Fed has done or what the political expectations have changed after the state election. But markets have already priced in a lot of good news. So are we in for a earnings season where you need to buy the rumor and sell the news, and markets could actually fall because of its own weight?
I don't think so. Given the flows into Indian markets, the flows waiting to get into Indian markets, I just can't figure out how Indian markets can fall big. And unless and until the result season is a disaster, which is unlikely going to be the case, I think you will always see India as a buy on dips market. At different points in time, you will have different sectors, perform. And on an aggregate basis, for the next 2, 3, 4 years, you'll have a uniform rally spread across all sectors. So the key is to buy sectors where there is pessimism, but the outlook for the next 2, 3 years is positive, because these are the only sectors and names within those sectors where you're going to find the valuations palatable. Otherwise, when you are actually buying into sectors which are already, visible growth is something like, very high, they are priced to perfection, so to speak. So I think it's a growth market, but you'll have to find value in that growth market. That's how one should look at it.
It's a very interesting number, which is that how many companies have managed to beat the expectations this time. And sequentially, one really starts from, let's say, Q3 FY23. I'm taking the clock 1 year back. 58% of the companies, 55% of the companies in Q3 FY23 managed to beat the estimates. That number was impressive, 54 in Q4, 58 for the quarter gone by, and for the Q2, the number was 55%. So are we in for a similar earning beats this time, Manish, that 50% plus companies are likely to beat estimates?
Yeah, I mean, I would believe that, this trend line number of outperformance sales vis-a-vis, what was estimated, should be in that ballpark range. I mean, the festive season has just gone. The third quarter numbers would capture all of that. Public spending is very high. So, and broadly, inflation has been stable than what was expected. So from that point of view, I think, there is some bit of caution when one tries to project the numbers. So to 10 to 12% sort of a earnings growth trajectory should be manageable, is what I believe is.
Okay. Now, Manish, what really ultimately matters is the EPS growth number for FY24. According to estimates, the consensus number is about 975 to 980. Are we in for an upward revision post the Q3 numbers? Let's look at those numbers just for the benefit of our viewers.
There's a case for a cut per se. I think broadly these numbers should hold. These numbers post the result season, once that is over, broadly the 975 ballpark here or there should broadly be managed. And I think then it boils down to how FY25 numbers are going to look like. And I think out there, again, the earnings growth trajectory seems to be somewhere in the vicinity of 16 to 18%. If that be the case, then I don't think valuations in Indian markets are expensive at all. And we see, buying that would come at every lower levels or even at higher levels.
Manish, you are of the view that even though markets have run up for the quarter gone by, double-digit returns, earnings season is not going to be a dampener and it will not set cats among the pigeon, and we are not in for a situation where markets will fall. It could be temporary, it could be volatility, but they are unlikely to see a big fall irrespective of the earnings season.
My belief is that, Indian markets can't fall big. Earnings season is unlikely to disappoint majorly on the downside. As expected for the Q3, if the earnings trajectory numbers are going to be something like a 10 to 12% growth. I think broadly those numbers would be achieved, if not outperformed. And the outlook going forward into FY25, apart from unforeseen circumstances, I don't really foresee how numbers can terribly disappoint for FY25. One of the major sectors which is being talked about vociferously, these days is the IT space and how the Q3 numbers are not going to be good. But that is a known thing. It's not that IT numbers are going to be good is not going to be good is something that's going to come as a surprise. The Accenture numbers, I already told you what the numbers are going to be. It's going to be about the outlook going into the next few quarters. It's going to be about the commentary. Post the announcement of the Fed cut, how is the discretionary spend picking up? How is the order pipeline looking? All of these things are going to matter. And I think the correction in IT stocks is broadly done. If one has to look at, so this is one of the spaces where there's too much of pessimism. Apart barring the commodity pack, etc., where there's not too much of interest on a pan-India, pan-market-wide basis, the known sectors like your pharma is likely to do well, consumer discretionary is likely to do well. Staples is going to be here and there, nothing majorly. But otherwise, broadly, the sectors of interest, should broadly do well. The industrials are likely to do well. Power is likely to do well. So I don't really see how markets can fall with that.
Banks and IT specifically, you are of the view that IT could be in for a dull quarter, but nothing scary. What about banks? They continue to grow. Post this earnings season, is money likely to come back to banks? Can they start outperforming?
It should be in line with the market performance because these are such a big heavyweight on the index. They move the index quite significantly because that's about 32 to 34% sort of a weight in the benchmark indices. And broadly has not given superlative returns, so to speak, 14, 15% sort of. But I think that trajectory of returns should ideally continue because banking sector as a whole is in for some margin, compression. And at the same time, given the clampdown on unsecured loans, the risk weights going up, systemically important banks having reclassification, requirement for more tier one capital, so on and so forth, should keep a lid on the upside as far as large cap banks are concerned. But broadly should be in line with the consensus, earnings numbers for this year and market performance, which was at the start of this year closer to around 15%. Broadly, they should be projecting that sort of return expectation into it.
All right, Manish.